Good afternoon, ladies and gentlemen. Welcome to the first in a series of Canadian Business History Talks. My name is Joe Martin, and I am both president of the Canadian Business History Association and moderator of today's session. For those of you who are not members of our association, we are a young body, only 5 years old, dedicated to preserving and presenting Canadian business history. We have hosted conferences, mostly at the Rotman School of Management, University of Toronto, but last year we went to McGill, where we had a conference on the Golden Square Mile. We were hoping to go west this year in late November to Winnipeg to have a conference to mark important dates. The 350th anniversary of the Hudson's Bay Company, the oldest multinational corporation in the world, and the entry into Manitoba of Confederation 150 years ago. Then COVID raised its ugly head. Our very creative Secretary-Treasurer suggested we initiate a series of TED-like talks, which we call CBH talks. This first talk is on the price of gold, lessons from previous cycles. The idea emerged from a brainstorming session as an ounce of gold approached $2,000, and some were heard to say it would make $3,000. From the beginning of time, people have obsessed about gold. It's attracted civilizations all over the world. Gold has been a part of Canada's history since the 19th century. Discoveries in the Eastern Township, followed by the Caribou Gold Rush, followed by the Klondike Gold Rush. Today, the Toronto Exchange has more mining companies listed than any other market in the world. Mining has also taken Canada all over the world. Mining is by far the most global of our businesses. 17 of the top 20 Canadian-based mining companies by market cap are gold, precious metals focused. Gold has helped build Canada through the wealth it has created. Toronto is probably home to more people who actively follow the gold price than any other place on the planet. I'm not an expert on gold, although when I was a teenager, I was in Val d'Or. In my 40s, I spent a lot of time in South Africa, and more recently, I visited Timmins, and I was struck by that every person there knew the price of gold that day. And I read Charlotte Gray's great books on the Klondike and the death of Sir Harry Oakes of Nassau. But I have with me a group of experts. Tony Fell, OC, is a Canadian businessman who was formerly chairman and CEO of RBC Dominion Securities, the corporate investment subsidiary of the Royal Bank of Canada. I prefer to think of him as the legendary Tony Fell, who shook up Bay Street when he was in those roles. I know him best because of his generous support of the Wilson Currie Chair in Canadian Business History at the University of Toronto. Stan Sudol, who will be the second speaker, in addition to being a neighbor of mine, is a Toronto-based communications consultant, freelance mining columnist, and owner-editor of republicofmining.com, a mining news aggregator website. His columns have appeared in both national and regional newspapers, such as the National Post and the Sudbury Star. Mike Parkins is a director and precious metals analyst at National Bank Financial Markets, our sponsor. He has received acclaim for his technical knowledge and stock picking abilities. Now, to you in the audience, if you'd like to submit a question, please do so via the Microsoft Teams chat function located at the bottom of your screen. So let the show begin. Tony, I'm going to begin with a question for you. Based on your long experience and your knowledge about cycles, not only in gold but in other commodities, please share some of your experience with the audience.
Thank you, Joe. Ladies and gentlemen, I am pleased and delighted to participate in this forum on gold and gold cycles. along with my fellow panelists, and especially my long-term friend Joe Martin, who has made such a tremendous contribution by founding and building the course in Canadian business history at the U of T Rotman School. So thank you, Joe, for organizing this session, and thanks to the National Bank for sponsoring it. I've never been a gold bug, but I've followed it closely over the years, as I have found the gold market to be somewhat mysterious, totally opaque, and endlessly fascinating. There are no reliable trading statistics for gold bullion, and apart from central bank transactions, it's almost impossible to trace who is buying and who is selling. There are gold markets in London, New York, but also in Hong Kong, the Middle East, Singapore, Switzerland, and India, and a host of unofficial gold markets around the world. The jewelry industry worldwide is a big consumer of gold and a big player in the gold market, along with central banks, global mining companies, exchange-traded gold funds, private hoarders of gold, hedge funds, Middle East investors and Swiss banks, billionaires from China, the Middle East, and around the world, South American and South Asian dictators, and of course, money launderers. So what is gold? In 1924, the famous economist John Maynard Keynes called gold a barbarous relic. And for the past few decades, Warren Buffett derided gold, saying it paid no dividends, paid no interest, and was just a useless metal. But after all these years, the sage of Omaha changed his mind and recently acquired a substantial stake in Barrick Gold for Berkshire Hathaway. Now, is gold a currency, a commodity, or a store of value? The answer is all three. But gold bullion is primarily a currency and a store of value, and is a long-term hedge against fiat paper money and inflation. As an economic consultant in 1966, Alan Greenspan wrote, "In the absence of the gold standard, there is no way to protect savings from confiscation through inflation. Gold stands in the way of this insidious process," he said, unquote. I say don't measure the dollar against the euro or the euro against the yen, but measure all paper currencies against gold bullion, because gold is the ultimate currency benchmark. The trend in the price of gold reflects global confidence or lack thereof in a particular currency. If gold is increasing in price in your currency, it means there is a lack of confidence in your money, and probably in your government and central bank as well. If you live in Zimbabwe, Argentina, or Turkey, or any one of a few dozen similar countries, gold bullion has been a great currency to own and also an incredibly good investment. At banks and dealers around the world, gold bullion should be traded off the foreign exchange desk rather than the commodity desk, because that's what it is, a global currency. As J.P. Morgan said in 1913, gold is money and nothing more. Gold bullion is the only currency which is freely tradable worldwide and which is unencumbered by vast quantities of sovereign debt and prior ranking claims, obligations. If you own US, Canadian dollars, or euros, or yen, you rank behind all their sovereign debt, all their pension fund and long-term Social Security obligations, which are massive. Gold has none of these prior obligations. It is totally debt-free, and it owes its allegiance to no country and no central bank. Gold bullion is the one investment and long-term store of value which cannot be adversely impacted by corrupt corporate management or incompetent free-spending politicians, each of which are in ample supply on a global basis. A gold primer. The World Gold Council estimates, or maybe guesstimates is a better word, that the total amount of gold mined since the beginning of time is about 198,000 tons, which would have a value of about $12.4 trillion at the current gold price of about $1,950 per ounce. In theory, based on these numbers, you could say if gold was a corporate equity, the company would have a market cap of 12.4 trillion. 198,000 tons of gold worth 12.4 million sounds like a lot of gold, but then consider global debt of all kinds amounts to an estimated 257 trillion. Global equities have an estimated market cap of about 90 trillion, and who knows the value of global real estate. So gold is in fact a very small but a very key player in the global financial system, especially when you consider half the gold is in jewelry and not readily tradable. Since gold is virtually indestructible, this means that almost all the gold mined to date is still around in one form or another, in jewelry, central banks, or private vaults, dental work, or wherever. If all of this gold in the world was melted down into one cube, it would measure about 68 feet square. Annual gold production is now estimated at about 3,500 tons, with a value of approximately $220 billion. Gold production is an incredibly fragmented industry around the world. Two largest producers are Newmont Mining and Barrick Gold, which combined produce about 360 tons annually, or only about 10% of global production. The five largest country producers are China, Russia, Australia, the US, and Canada. There are literally hundreds of medium-sized and very small boutique producers around the world. Who owns the gold? Well, these are extremely rough approximations, but the World Gold Council estimates the total above ground stock of gold was distributed roughly as follows by the end of last year. Jewelry of all kinds, about 47%, private investment vaults, 22%, central bank vaults, 17%, miscellaneous categories, 14%. As I say, there's a lot of guesswork in these numbers. Historical price of gold. Gold has been a long-term store of value and protection against inflation for well over 1,000 years. But just looking at recent history, after the financial panic of 1893, the US passed the Gold Standard Act in 1900. This act set the price of gold at $20.67 per ounce, with the US dollar fully convertible at that level. During the Depression, the US passed the Gold Reserve Act of 1934, and President Roosevelt raised the price of gold from $20.67 to $35 per ounce. The US dollar remained fully convertible at that rate, stayed so for the next 37 years. In the late 1960s, there was a growing loss of confidence in the US dollar, caused by a concerning increase in the US balance of payments, never-ending spending on the Vietnam War and on President Johnson's Great Society programs, an increasing US government budget deficit, and early signs of rising inflation. Some central banks, led by France at the time, which held substantial US dollars in their foreign exchange reserves, were losing confidence in the US dollar and began to gradually convert their US dollars into gold at the Federal Reserve gold window at the stated price of $35. This gradually became a run on the US gold reserve. In light of this, at the time, the major central banks formed a gold pool to sell gold to hold down the price, but eventually the gold pool was overwhelmed. In 1970, as other central banks joined France in converting dollars for gold, President Nixon, to protect US gold reserves, was forced to close the gold window, which he did on August 13, 1971, when he directed the US Treasury to suspend the convertibility of the US dollar into gold. The US dollar dominated world trade at that time as it does today. So with that single stroke, the world transitioned from a hard US dollar convertible into gold at a fixed price to a fiat US paper dollar backed only by the full faith and credit of the United States. Fiat money is defined in the Oxford Dictionary as inconvertible paper money made legal by government decree. In other words, they can print and issue as much money as they want. Henceforth, gold would trade freely on the open global market as an independent, autonomous, freestanding currency, beholden to no one. This transition to fiat money was a huge turning point, but most people do not realize even now, I think, the long-term implications, some of which we are seeing now with the Federal Reserve, the Bank of England, the ECB, and the Bank of Japan printing hundreds of billions of fiat money, in aggregate many trillions of new paper money in the various currencies. Recent gold price performance. Steve Forrester, a professor of finance at the Ivy Business School, has done some interesting work on how gold has performed relative to the US Standard & Poor's 500 index. His work showed since 1970, when the gold window was closed, adjusting for inflation, the S&P 500 has provided a real return after inflation of 7.2% annually, compared to 4.5% for gold. It's of interest that this outperformance of equities was due entirely to dividends paid. Of course, gold pays no dividend or interest. Professor Forster's work also shows it depends a lot on when you buy and when you sell. If you consider the last 5 decades since 1970 independently, stocks outperformed in 3 of the decades, but gold outperformed massively in 2. In the 1970s, with a real return of 23.6% annually, and from 2000 to 2010 with a real return of 11.6%. It's of note that the worst time to hold gold was the almost 20-year period from 1980 to 1999, when gold declined 70% and you received no dividends or interest. It was a brutal bear market, due primarily to Fed Chairman Paul Volcker, who defeated inflation with incredibly high interest rates, and the impact was felt for 2 decades. Since the current bull market commenced in mid-2015 with gold at 1,050, gold is up 86% and the S&P 500 76%. Now, how do you value gold? The answer is with difficulty. Valuing gold is far more challenging than valuing a commodity like copper, nickel, or oil and gas. Because with such commodities, you can forecast production and make a reasonable estimate of industrial consumption and an estimate of whether there's likely to be a surplus or a shortage, which could impact the price of that commodity. With gold, there is minimal industrial consumption, and half goes into jewelry around the world, which is impossible to trace or forecast. Gold will usually fluctuate up or down depending on global confidence in fiat paper money and in confidence in the international financial system. Valuing gold is much harder than valuing a stock. With gold, there is no yield. There's no price-earnings ratio, no price-to-sales ratio, no price to EBITDA or enterprise value. So there is no historical benchmark guideline. Also, there is no comparable investment to benchmark against. Gold just floats on a global sea of fiat paper money and investor sentiment and confidence. When the gold price goes up relative to a particular currency, it probably reflects an anticipation of rising inflation in that country, and also reflects a lack of confidence in that particular fiat paper money, that country's central bank, and political backdrop. When you cut through it all, gold is the canary in the coal mine when it comes to inflation or instability in the global financial system. Where to now? Looking ahead, my own view is that the stage is set for higher gold prices over the coming decade. There's no point in forecasting a particular level or time frame because no one can be that precise. The 2 primary determinants of the gold price is the prospect of future inflation and confidence or lack thereof in the US dollar. As a result of the Great Recession in 2008 and the recent pandemic and the gradually slowing global economy for the past many years, many central banks have become more concerned about the risk of deflation, disinflation, or deflation. This has been the case for a long time in Japan and now in Europe. Accordingly, some central bank mandates have been broadened to include full employment, and some have established a formal or informal inflation target, generally around 2%. In the US, having generally failed to reach 2% inflation, core inflation, over the past many years, the Federal Reserve is now openly encouraging inflation with a new target of an average of 2% inflation over a number of years, meaning they are comfortable, perhaps with inflation at, say, 3% or 4% for several years to compensate for the many years under 2%. This, I think, is a slippery slope. In fact, central banks have done a 180-degree turn, and instead of worrying and fighting inflation, are actually promoting inflation. Governments and central banks are far more afraid of deflation than inflation. Stated differently, central banks led by the Federal Reserve now have an official policy to devalue and debase their currency. And I think this is an incredible and almost unbelievable sea change from the past 50 years. I'm not sure why they want 2% inflation, because at that rate you lose about 20% of your purchasing power in 10 years, and at 3% inflation you lose about 30%. Is that what you want? It's often been said that there's no such thing as a little inflation, and once started, it's very difficult to control, and the record would appear to bear this out. There used to be a check on government spending due to the strong desire to balance government budgets. But now borrowing is so easy and so cheap, there is little interest in balancing budgets. And the new guidelines of debt and/or debt servicing costs as a percentage of GDP are totally meaningless due to record low interest rates. In the US, government debt is climbing dramatically, but total debt service costs are declining even faster as they roll over high interest debt to the new low rates. Now we are now witnessing an epic global battle between deflation and inflation, which in my view will take some years to play out. At the moment, deflation would appear to have the upper hand. When you look at the big picture over the past 60 years, we all have witnessed the formation of a giant global debt and credit bubble. In the past 30 years, every time there was an economic slowdown or recession, central banks lowered interest rates to encourage all sectors to borrow and spend to spur the economy, which they did with a vengeance. It's hard to believe that the yield on 10-year US Treasuries peaked out slightly over 15% in 1980 and has since declined to the current level of 0.68%, a reduction of 95%. Stated differently, the yield on US Treasuries has fallen in half 4 times since 1980, from 15% to 7.5% to 3 3/4, then to 1.85% to the current level of 0.68%. This has been an incredible boon to borrowers, and debt has exploded. It has not taken long for governments, corporations, and consumers alike to figure out that when interest rates fall in half, they can borrow twice as much. And when they fall by half again, they can borrow twice as much again. Central banks now have both hands deep in the cookie jar. The Institute of International Finance has estimated total global debt at $257 trillion at the end of March this year. And this would now be very materially higher right now due to the recent stimulus spending. This number is very similar to World Bank numbers. It should be noted that since the global recession in 2007-8, global debt has been increasing far more rapidly than global GDP. And obviously, this is an unsustainable trend long term, even with low rates. The problem with a credit and debt bubble is you have to keep feeding the beast or it will collapse. Even at current low rates, $257 trillion of global debt is a powerful deflationary drag on the global economy. Offsetting this now is trillions of government stimulus spending in North America, Europe, and Asia, with indications of much more to come. It's my view it's an open question of who will win this inflation-deflation battle. Central banks have been trying to increase inflation for several years, particularly in Japan, but without success. Even with massive borrowing and spending, will the future be any different? Nevertheless, central banks and governments can print as much money and liquidity and credit as they want, and they have basically said they will do whatever it takes. An interesting aspect of all this is that the 3,500 tons of global annual gold production only increases the amount of gold in the world by less than 2%, while at the same time the money supply and credit provided by the world's central banks is increasing multiple times faster, maybe 10 to 15 times faster, which should provide a strong upward bias to gold prices over coming years. We have no idea how all this debt issuance, quantitative easing, and money printing will end. But the record clearly shows that prolonged periods of super low interest rates encourages borrowing, risk-taking, and speculation, all of which usually have a very unhappy ending. There is now dramatically more leverage in the international financial system than there was 10 or 20 years ago, which is worrisome. At a time like this, we would now be well to heed the words of the famous Australian school economist Ludwig von Mises, who lived from 1881 to 1937, who said, and I think this is important, and I quote, "There is no means of avoiding the final collapse of a boom brought about by credit and debt expansion. The alternative is only whether the crisis should come sooner as a result of a voluntary abandonment of further credit expansion, or later as a final and total catastrophe of the currency system involved." So Joe, that concludes my remarks. And I turn the microphone over to you now, and that later on, I look forward to any further discussion.
Thank you very much, Tony, especially for that very cheery ending. Now I'd like to turn to Stan. Stan, you and I have often talked about how few people know how rich Ontario and Quebec are in gold. Please tell us a little bit about the importance of gold, not only in Ontario, but also in Canada.
Thank you, Joe. We'll get right into this here. Canada is the second largest landmass in the world after Russia and has some of the best geology to be found on the planet. So it is of little surprise that this country is one of the leading producers of raw materials that are the foundation for any modern industrial economy, as well as precious metals that are an integral part of global financial markets. And yet most urbanized Canadians are not that familiar with the fascinating history of the mining sector, apart from the Klondike Gold Rush from 1896 to 1899. This discovery was the beneficiary of terrific public relations from writers like Jack London, Pierre Burton, and Robert Service in his iconic poem, The Cremation of Sam McGee. I'm going to largely focus on gold mining in Northern Ontario and Quebec and their enormous economic impact. Ironically, just a few years after the Klondike ended, it only produced about 12 million ounces of gold. The London Times boldly stated in a 1901 article that Canadians were foolish to dig holes in the ground in the hopes that Canada may at some time produce a few ounces of precious metals. They could not have been more wrong. To help spur the colonization of the rich clay-built region of Ontario's isolated northeast, then Premier George Ross funded the construction of the Temiskaming and Northern Ontario Railroad. In 1903, about 145 kilometers north of North Bay, various individuals separately discovered silver and the boom began. Many historians call the cobalt silver boom the cradle of Canada's mining industry. Cobalt enhanced the prospecting and mining capabilities of Canadians, and most importantly, provided the necessary financing for future mine development. Roughly 100 mines were developed over the life of the camp. The majority of the deposits were fairly shallow, and smelting silver was rather easy, allowing for lower capital costs. The boom, which saw an astonishing 460 million ounces of silver produced, was largely over by the end of the 1920s, but a few mines hung on until the 1960s. In comparison, the Sudbury nickel camp, which was discovered in 1883, contained a complex ore which was often found at great depths and needed American metallurgical technology and capital. Today, Sudbury is still producing nickel, copper, platinum group metals, and smaller amounts of gold and silver. It has been estimated that the economic impact of the Sudbury Basin is about $1 trillion. New mines are being discovered, and nickel is one of the key components of electric vehicle batteries, which suggests continued prosperity for that community. Going back to gold, the legendary gold-producing Abitibi-Archean greenstone belt is the largest in the world. It's roughly 150 kilometers wide and stretches from just west of Timmins in Ontario for about 650 kilometers to Chibougamau, Quebec. This greenstone belt has produced around 200 million ounces of gold, 466 million ounces of silver, along with roughly 35 billion pounds of zinc and 15 billion pounds of copper. Gold discoveries in Timmins in 1909, the richest gold camp in Canada with 76 million ounces to date, and Kirkland Lake in 1911, the second biggest gold camp in Ontario, were found due to the cobalt silver boom. In addition, a string of gold and copper discoveries on the Quebec side of the Abitibi during the 1920s included Rouen, Val d'Or, and Malartic. This area is often called Quebec's Klondike, which helped settle and bring prosperity to that isolated region. Over in northwestern Ontario, they had their own smaller greenbelts that saw the Red Lake Gold Rush in 1925, while significant gold discoveries were made in the Pickle Lake and Beardmore Geraldton camps in the late 1920s and early 1930s. All of these camps are still produce gold today and or are attracting enormous interest from the junior exploration sector. As the old saying in the mining industry goes, the best place to find a new mine is in the shadow of a headframe. The development of the gold camps throughout northern Ontario and northwestern Quebec, though there were also base metal discoveries, had a major impact in establishing Toronto as Canada's financial centre. The Toronto Stock Exchange was formally incorporated by an act of the Ontario Legislature in 1878. Various mining exchanges were also established for short periods of time, the last one being the Standard Stock and Mining Exchange in 1908 due to the huge demand for cobalt securities. As the Great Depression tightened its grip on the US and Canada, President Roosevelt made the possession of gold illegal in 1933 and increased the price the following year from US $20.67 per troy ounce to $35. Canadian gold exploration and mine development exploded with activity, allowing Toronto's financial community to weather the Depression much better than Montreal. Gold mines were given a tax exemption in 1936 to encourage development in Canada, and Ontario's large production of gold allowed the country to maintain its credit and substantially reduce the debt. From 1931 to 1941, Timmins doubled in population from 14,000 to 28,000 people, while Kirkland Lake grew from 1,200 to almost 10,000 during the same period. Even the base metal mines of Sudbury prospered during much of the 1930s, though unfortunately it was due to the impending war and increased demand for nickel, which was and is still used in a variety of military applications. Obviously, this presentation only covers a tiny sliver of Canada's amazing mining history, which helped settle much of our north and its enormous economic contributions to the country. However, let me provide some interesting closing context. Vale's Creighton mine, which started production in 1901, is still going strong at 8,000 feet below surface. The deeper the company goes, the richer the nickel copper ore becomes. Kirkland Lake's Macassa gold mine started producing in 1933. With new discoveries at deeper levels and 320 million in new investment, the deposit's life will be extended for another 30 to 40 years. Conversely, car manufacturing at Oshawa's General Motors plant started in 1907 and unfortunately closed in 2018, dealing a devastating blow to Southern Ontario's auto-focused economy. Similarly, in 2011, Ford permanently closed its giant St. Thomas plant that originally opened in 1967. Now there are rumors that the future viability of Ford's Oakville assembly plant is not that secure. I'm not suggesting that we just focus on the country's mining sector. However, for the past generation or so, there has been a somewhat dismissive attitude towards the industry and a significant lack of knowledge about the numerous high-tech applications driving the sector forward today. That needs to change. Sustainable mineral development is also playing a key role in the economic reconciliation that all Canadians wish to implement with First Nations, many who benefit greatly from the mines near their isolated communities. In addition, the large capital expenditures on mining projects will help Canada weather the COVID economic storms we are currently facing, similar to the sector's positive impact during the Depression era. Politicians and media should be aware of these developments and supportive policies need to be implemented, and most importantly, strategic infrastructure built to reflect these key issues. Thank you. Over back to you, Joe.
Thank you very much, Stan. That was great. Okay, Mike, it's your turn. Mike, you know more about the present and the future than the past. As Director, Precious Metals Analyst at National Bank Securities, where is gold going in the near future? To 2,500, to 3,000, or back to 1,500?
Thanks, Joe. I get those questions from mining CEOs all the time, why I don't use a higher gold price. So we'll delve into it here. I've got a presentation deck that my screen is shared, so you should all be able to see this clearly. So we'll just flip through into the heart of it. A couple of these topics have been discussed in the introduction. The gold price, versus the US dollar. We specifically look at the US dollar index, and historically there's been an inverse correlation. It kind of fell apart in 2019, but you can see on the left chart there, it's come back quite strongly as the 2020 year has started off. When you're looking at the right chart, you're seeing a blend of solid lines and dashed lines. The dashed lines, we're using Bloomberg forecasts right now, so you're getting a consensus view of all economists that contribute to that in terms of where they see expectations going forward. So right now, you're looking at the US dollar index, or the DXY, expected to weaken into basically the end of 2021. And that being supportive for the gold price on a relative basis. Then you're looking at a bit of a recovery to start 2022. Fed comments yesterday, aren't factored into these forecasts. My personal opinion would be they'd be supportive of a more robust outlook for the gold price beyond 2021, and we'll be watching as these kind of numbers move forward. Moving on to the next slide, another key thing that we watch in terms of where we think the gold price might be going is interest rates and inflation, also discussed in the earlier part of this presentation. And right now you're looking at, to the point inflation's target of 2% doesn't tend to be hit regularly and sustainably. Was recently kind of in that range back in the 2017 through the 2019 period, fell off a cliff with the development of COVID as declared as a pandemic, is recovering a bit and is expected to continue recovering up to about the 2% range by the spring of next year. That alone we don't tend to consider by itself. We like to look at real rates. And with the Fed expectation of no rate increases for the immediate future, there was an updated view on that provided in the recent Fed minutes, and that there's no change there. If anything, it's pushed it out further. So the expectation of real rates falling as we go into 2021 is, should be no change there, with updated estimates coming out as we're speaking. And, therefore, with the relationship that gold is a store of value in negative real rate times, suggests that there's a supportive environment from that basis as well. It was a good point to make that, predicting the price of gold is, not as easy as, in terms of something more like a base metal, a copper or lead or a zinc from a supply and demand trend. We do pay attention to some key factors as it is important, but, certainly with a massive amount of gold available to be recycled at any given point, the supply of gold could fluctuate dramatically on any kind of price movement. So here we've shown, roughly the last 10 years and our year-to-date figures. You're seeing the mine production number expected to actually slip on an annualized basis for 2020. That's different than what we've seen for the last several years, with it being fairly flat. What's driving that is the impact of COVID having negative consequences in terms of implementation of safety cultures that required a lot of the mines to have periods that were shut down through Q1 and Q2. So we would expect that the second half of 2020 will show a better number than that, just shy of 1,600 tons figure there on the top right corner of your screen. The other thing to note there on the supply side is recycled gold. You're seeing the gold price average for the first half almost $1,650 US an ounce, well above a number of the past years. Yet the gold recycled sits below 600 tons. Annualized would be sub 1,200, almost 1,100, which is would be considered the low of that period. So recycling of gold is not kicking up, and that's really interesting when you see the bottom of that first table, the larger table. You look at Indian rupees and Chinese yuan price gold. That's important to note. A lot of people always kind of forget to think of the gold price in other currencies, and they only focus on the US dollar. Well, it was stated that India and China are your two biggest consumers of gold. So you should really pay attention to what the gold price is in their local currency. So we're a bit surprised to see the recycling of gold still fairly low, given the very, very strong price in rupees, as well as Chinese yuan. Jewelry demand was, on the demand side, is a big component. That's suffering from China and India in terms of lockdown measures. You're seeing a rebound in demand for the jewelry out of China in Q2, and we're hearing that there is a return of demand in India after lockdowns were eased. But things to watch there would be the COVID numbers, as India's seems to be outpacing the States in new cases of COVID, which might weigh on that demand in the back half of this year. ETFs is the last thing I'd mention here. It was also brought up earlier in the presentation as a strong component of demand. Here, just year to date, we've almost doubled all of the ETF demand of 2019, and doing very well compared to the last bull cycle in gold, where not even 400 tons in an annualized basis was achieved. Just kind of mapping it out, you can see the flat gold production. We're going to see a little bit of a dip in 2020 and probably a rebound in 21, and then the blue being the recycled gold. So although you're seeing quite a change in the gold price over those years, recycled gold does tend to be fairly steady, and I don't expect that to change much. ETF, just a graphical representation. Interesting to note that total gold holdings of ETFs amount to about 1 year of annual production, and it's up quite a bit year to date, rising 32%. The biggest ETF is the Spider, represented in this light blue color at the bottom. We were also asked to bring up and discuss a couple of trends that we're seeing in the sector. One is on M&A. So this is a chart showing the cumulative total value of deals done over $100 million. You saw in the last bull cycle, a couple very big years in terms of M&A, almost 30 billion in 2010. 2019, you did see a massive resurgence in value, but it's really explained by just two deals. One being the $10 billion Newmont Gold Corp, and the other one being the $6.5 million Barrick and Randgold. Strip those out, and fairly low year to date, fairly low as well. And from communications made by the CEOs and boards of the mining companies that we talk to, not expecting to see that change in the near term, but I'll touch on something that maybe sees a change to that coming a little more medium term. The next one, what is the industry doing in terms of capital expenditures? You saw a really big build phase in the last gold cycle, spending as much as almost 50 billion. That really fell off a cliff when the gold price reversed. There was also a tendency to leverage the balance sheet by funding a lot of this development with debt. And so through this period of the 2014, 15, and 16, you saw a real focus on cost reduction as well as debt deleveraging. Here we are today, and we're still not seeing much in the way of a resurgence in capital spending. And even for the first half of this year, we don't have the numbers there, but you're not seeing a massive jump up. There is not a massive build trend kicking in like we did see in the last cycle. This is a bit of a busy chart. What it is it's the production weighted average fully baked all-in sustaining cost of the top 10 global gold producers. This is National Bank Research work, and the one thing to note here is the little blue bar at the top. That's amortization, which we use as a proxy for sustaining capital. It's not exactly a perfect representation of sustaining capital, but given that sustaining capital isn't perfectly disclosed by these parties, that's what we're using. What's with the two red lines? That's basically what you're seeing reserves, being determined with. Basically an assumption of something between 1250 and 1350. Today's costs aren't really generating returns. So you'll likely see that moved up in the new year when they announce reserves for the year end 2020. The key thing here is inflationary pressures. The red bar is getting bigger, that's cash taxes. White bar is increasing a little bit, exploration expenditures growing as well. And we don't see that trend probably diminishing. This is some work that we use to derive our long-term gold price of $1,475. We look at it in terms of what is the minimum gold price needed to see investment approved in the gold sector. And that basically is a 15% IRR to the cost structure. And then just finally, what is, a couple of the trends from a production basis that we're seeing in the industry. The two lines here on the chart, they represent the average grade milled or heap leached through the industry over time. The left-hand chart's a little blurry, I apologize for that. It's a chart we've taken from Wood Mackenzie, starting back in 2000 and then forecast out to 2025. So this is Wood Mackenzie's forecast. You're seeing production has risen, which we've shown in the supply and demand table, but grades have really diminished. And certainly in the 2010, all through like even 7, 8, 9, we saw a lot of lower grade projects brought on, expansions to allow for lower grade material to be brought into the circuit. So that's what's really kind of driven that diminishing grade and stabilization of production. One thing I would note here is this green and yellow section over on the right-hand side. It explains, project growth, and you're starting to see a rollover of what's actually in production now. I would say that's maybe a little aggressive. It doesn't fully assume a reserve replacement year over year, which the industry does tend to have a pretty decent track record of. So it might be declining. I don't think it would be quite declining at the rate that it's showing there once we get out to that period. So that's it for me. Joe, I'll hand it back over to you.
Well, thank you very much, Mike. That was terrific. We'll now have a few minutes for questions. The first question is directed at Tony. Tony, what past corporate strategies during the gold cycle worked for investors?
Well, you can see, I guess the first point I would make is that I don't think it makes sense to try and trade gold on a short-term basis. It's impossible to forecast where it's going over the next month or two, or even over the next year. I think the record shows that you should take a very long view. Now, looking back, hindsight is always 20/20. But in 1970, when we saw what was happening to the U.S. balance of payments deficit and the U.S. dollar, I guess we should have known that was going to be a good, we were coming into a good period. And indeed, it was an incredible period to be in gold that whole decade. And similarly, in 1981, when Paul Volcker came in and raised rates to 15%, and was totally dedicated to reducing inflation, gold had had an incredible 10-year run. I guess if we really thought about it, we would have unloaded our gold shares at that time, because the next 20 years were really very difficult for investors in the gold market. The reason I sort of like where we are right now, looking ahead over the next 10 years, is, as I outlined in my comments, I think the ingredients are here for a good long-term bull market in gold. The governments want inflation. They need inflation to spur the economy. And I think they're serious about printing money. And I think that the global financial system is far more leveraged now than it ever has been. I think there's more uncertainty in the global international financial market. We are in totally uncharted water. We've never seen anything like what is going on now in terms of negative interest rates on government debt over a good swath of the global government debt. We've never seen quantitative easing of this magnitude. In fact, we've never seen like what's going on in the UK now, where the government quantitative easing is interesting because the Treasury sells bonds into the market and then the central bank buys them back. In the UK, what's going on now, the government's just selling the bonds directly to the Bank of England. That's total monetization and money creation. And I think the drag of $270 trillion of global debt on the economy. Also, I think we're going to see as supply chains have been severely disrupted by COVID. There's a lot of uncertainty about supply chains, and I think companies are going to be far more conservative, and perhaps a lot of production, not a lot, but certainly some production of goods that was done in low-cost countries is going to be brought back to North America, which means higher costs. I think food inflation is going to be a big factor over the next 4 or 5 years. So I think you've got to do your homework and figure out where it's going over a longer term basis, 5 to 10 years. And I would say that the 2020s are going to be a good place to be for gold, but I don't think you should try and trade it because you can't put a timeline on it. Like I remember in the bull market of the 70s, gold initially went from $3,500 to $35 an ounce up to $500. Then over a couple of years, it went back to $250. Nobody saw that coming. So it's unpredictable. So I think you got to look at is this a good time to be thinking, look at the basic qualities of gold and why it goes up. Is this a good time to have a reasonable percentage of your portfolio, 5 or 10% maybe, in the gold sector? And I think that's where we are right now, but I wouldn't trade it. I'd buy it thinking you're going to hold it for at least 5 years and maybe longer.
Thank you, Tony. Mike, we've only got time for one last question. It's a double barrel question, so I'm going to give you a big question and ask for a short answer. How do CEOs and gold companies today think about the price, and when will we see peak global gold production?
Right now, lessons learned from the last cycle was, don't chase the gold price, which, Tony kind of alludes to in his, recommendation in terms of investing. And that got a lot of these companies into some deep trouble with, significant amounts of debt, which, on a net debt to EBITDA basis, when you were using $2,000 gold didn't look so bad. But when we went back to sub, 1,300, it really kind of rang true that maybe there should have been some more fiscal discipline and, more prudent capital allocation in the last cycle. That's what we're seeing here. We've gone through the 2012s, right? 2013 through to 2017, and even still continuing today, has been a big focus on cost reduction as well as financial deleveraging of the companies. So before stepping back into, making a mess of themselves, you're seeing more discipline on capital allocation for now. Free cash flow seems to be king, messaging anyone that is, going against, looking to harvest free cash flow, return capital to shareholders is generally underperforming in this market. But at some point, the debt does get fully cleared up in fairly quickly at these kind of gold prices. So balance sheets start to become abundant in cash. And I kind of wonder, will the next M&A cycle not be kicking in 12 months' time from now? In terms of production peak, that's the thing, that forecast on the last slide right there, if you can still see the shared screen, it shows it rolling over, without new development. We do have balance sheets that can support investment, but if people are using more conservative gold prices, those being the boards and management teams of companies to make those capital allocation decisions, and you're seeing some of that still hanging in today, where you're not seeing a lot of investment in expansions, development of, kind of low IRR projects. So it could be not too far out. Obviously we're going to see a bit of a dip in production this year, but sustainably, I think you're in for at least flat production for, 2, 3, 4, 5 years before you'd have to worry about it. But it does really depend on the gold price. If we're sitting at $2,000 gold, people can afford to invest in projects. So if we saw gold move back to the $1,300 level, I think peak gold's near term. And if we say in a sustained high gold price, it'll certainly push it out maybe possibly 10 plus years out.
Thank you, Mike. With the firm eye on the clock, I gotta wrap this up. We did get a question that Stan didn't get a chance to answer about whether government will introduce new policies supportive of the gold producers, and as a betting man, my answer would be no. So in conclusion, I would like to thank you and the audience. I want you to know that this is the first of a series. The next one will be on October, late October, on the pandemic chair, and the chair for that will be Dimitri Anastaskas, who is also the chair of the Wilson Curry Business History Program at the University of Toronto. He has one of the panels will be a woman from the University of Quebec, Montreal. The other will be an academic from Northern Canada. And then in November, we will switch to the vices. We're looking at a program on alcohol, i.e. prohibition, also coffee, and also cannabis. And one of our board members, Tabitha Fritz, will be chairing that, and she is experienced in the cannabis business. So thank you, audience. Thank you very much, panelists. And thank you to the producing team. Very much appreciated. Good day.